Hi, I'm Mike Voynich. I'm a partner here at Evershed Sutherland. With me is Nick Rinaldi, an associate here at Evershed Sutherland. We're members of the firm's asset management team. Today we're here to talk about proposed changes to the definition of accredited investor under Regulation D. Regulation D has been the backbone of the SEC's exempt offering network as evidence of the fact that it is the primary source by which private companies raise capital. In 2018, more than $1.7 trillion in capital was raised under Regulation D, as compared to $1.4 trillion that was raised under registered offerings. The purpose of the definition, the SEC has stated routinely, is to provide an exemption for sophisticated individuals or those that it feels can sustain the loss or can otherwise defend itself, can defend itself against the potential loss. The purpose of the current definition is to further harmonize the definition with the rest of the exempt offering network, and also to expand the definition, the analysis of sophistication beyond more than just a mere wealth analysis. So Nick is going to talk a little bit about some of the proposed changes, and then we'll discuss the implications. Nick?
Thanks, Mike. So the proposed definition seeks to enhance, both from a natural person's and from an entity perspective, the types of individuals that would be able to invest in a private fund offering. From a natural person perspective, the rule now seeks to include those individuals with either certifications or designations as accredited investors. The rule also seeks comment on whether there are additional types of designations that should be included within the definition of accredited investor. Next, from a knowledgeable employee perspective, the firms that do private fund offerings would now be able to have those employees that do not meet the income test to be able to invest in private fund offerings. From an entity perspective, entities that have $5 million or more in investments but are not formed for the purpose of investing in private fund offerings could be considered accredited investors. Also, family offices today that have more than $5 million in investments would be considered accredited investors, as would their family office clients. Additionally, the rule now looks to have a spousal equivalence definition whereby both spouses could combine their assets together to meet the accredited investor definition. Mike, if the rule as proposed would be written as final, what are some of the market implications that you would see?
Great question. So I think the first, we look at the natural person inclusion. I think that's going to have more of a significant impact on the early stage and startup space than it is in the private fund space. The size of the capital raises for early stage and startup companies is going to be more conducive with the size of the checks that these additional natural persons can bring to the table. With regard to the private fund space, it's probably not going to have a material impact, including these additional natural persons, primarily because if the private equity fund is relying on 3C1 as an exemption from the Investment Company Act, it's going to be limited to no more than 100 beneficial owners. And given the size of the capital that the funds are looking to raise and their minimum commitments, compared with the size of the checks that these additional natural persons can bring, it's probably not going to have a material impact on the overall capital raising. If the fund is otherwise relying on 3C7 for its exemption from the Investment Company Act, the qualified purchaser standard that goes along with that has a higher wealth threshold already. So it's unlikely that you have one of these natural persons, these new natural persons that wouldn't otherwise be an accredited investor, be able to participate. With regard to the changes to add knowledgeable employees under the definition, I think that will help give some private equity sponsors some relief from having to rely on 701 under the Securities Act for being able to allow their employees to participate. With regard to the inclusion of the family office under the definition, I think that's intended to harmonize with the family office rule under the Investment Advisors Act. And then with regard to the inclusion of the catch-all, the entities with investments more than $5 million, I think that's just going to give some flexibility so that the SEC doesn't have to provide guidance every time there's a new development or a new type of entity that's created. So with that, we would like to thank you for joining us and watching this video. For more on changes to the definition of accredited investor or for other bottom line videos, please join us at evershed-sutherland.com.